Let's go to London now and get some more news on that Swiss story, which was one of the biggest stories, not just of the month, of the year, of the last 10 years, but of the last generation, I suppose. On the telephone now from London is Michael Hewson from CMC Markets. Michael, I don't know how long you've been in the markets, but I've been speaking to people today that have been in the markets for 25, 30 years, and they've never seen anything like it. In other words, a 30% appreciation of a fairly major currency against a very major currency. I don't know what the fallout's going to be, but certainly we'll find out quite soon.
Yeah, absolutely, and you're absolutely right. I've never seen anything like it. This was even worse than the 1992 occasion when sterling dropped out of the exchange rate mechanism. And I think the reason, obviously, that the market was caught so off guard by this was that on the 5th of January, Thomas Jordan, who's head of the Swiss National Bank, said that the current monetary policy and the peg was a key pillar of the Swiss economy, and yet we are here 10 days later, and he's basically opened the trapdoor on the market, caught the market completely off guard, and sent the Swiss francs spiralling higher. And I think more than anything, it's an acknowledgement, more than anything else, that the peg is becoming increasingly unviable. And I think that's why the Swiss National Bank has done what it's done, but unfortunately it's done an enormous amount of damage to its credibility, and I think central bank credibility overall.
Michael Nuzipo here in Johannesburg, you say that the peg is becoming increasingly unviable. Would you say that we're seeing the beginning of a larger trend? Could there be other currencies that could be looking to unpeg themselves from the euro?
I certainly think it's going to become increasingly difficult for some of these currencies to tie themselves to the euro. Certainly the Danish kroner is going to come under significant pressure given the fact that it is actually pegged to the euro. But I think more than anything else, the Swiss National Bank's reasons for actually untying this peg, while valid, have been communicated very, very badly. And I think they're also underestimating the effect that it will have on the Swiss economy. We've certainly seen the effects of that already on the Swiss market index. That's down 9% today, on the back of the fact that the likelihood is there's going to be a significant hit to Swiss exports as a result of this currency appreciation, which I think more than likely is likely to get worse because of next week's meeting of the European Central Bank.
Yeah, 22nd is that meeting, and of course the lawmakers allowed the well, sort of cleared the path, Michael, for quantitative easing, possibly on a massive scale, so we're all awaiting that next. But obviously the Swiss said this is just too expensive. We can't keep it at 122. We can't do this. We're going to lower interest rates to 0.75%. We've thrown in the towel. I wonder who else will throw in the towel, and I wonder what the fallout, as I've said before, will be for the euro. We've seen the euro go to a multi-year low today. Is this the free hit of 2015, sell the euro?
That does appear to be the case, and certainly the market is expecting a large-scale quantitative easing program, but I think it's time for me to inject a little bit of a note of caution. Certainly the expectation is that we're going to get something announced next week, but there are politics at play in here, and let's not forget that yesterday's European Court of Justice announcement was just that. It's an announcement, it's non-binding, and the likelihood is that the European Central Bank is going to find it extremely difficult to launch a large-scale bond buying program if the Germans object to it. And the likelihood is Mr. Draghi is going to find it very, very difficult to actually get the type of quantitative easing program that he needs to get to actually improve the Eurozone economy. Yes, we're certainly seeing the effects of a weaker euro in the context of the stock market move higher that we've seen in the German DAX, the CAC Caron and the Italian 40. But I think there is a significant expectation that markets may be getting a little bit ahead of themselves. Mr. Draghi has to deliver next week, and if he doesn't, we could reverse quite sharply.
Michael, we've often seen or traditionally seen the Swiss and gold competing for that safe haven status. How does today's decision impact on that competitive space?
Well, certainly we've seen the effect on the gold price. Gold prices are significantly higher, though I think it was interesting to note that when the decision was first announced, gold actually took quite some time to react. But I certainly think we're going to get an awful lot more capital flows into gold, because I think one of the things that this announcement has done is it's going to make it that much more difficult for investors to take central bank announcements at face value. Certainly Mr. Draghi 2 or 3 years ago said that he would do whatever it takes to preserve the euro, and thus far he's done that. Thomas Jordan said that he would basically uphold the cap on the euro Swiss with utmost determination. Well, we've just seen how that's ended. You know, central banks are looking to improve their communications. Well, today's announcement has done an awful lot of damage to that, and it will be interesting to see how markets respond to future policy announcements going forward. One of the things Mr. Jordan said about one of the reasons for removing this cap was the expectation that the Federal Reserve could well start raising interest rates this year. Well, I think that's slightly optimistic. I don't think that the Federal Reserve will raise interest rates this year, and the reason why is because of what's going on in China and in Europe and in Japan. Deflation, falling prices. It's unrealistic to assume that the US will remain immune from that. We saw those non-farm payrolls numbers last Friday, and the wage growth numbers, which actually saw wages slide back. The Federal Reserve will find it very, very difficult to raise rates when prices are falling. It has an inflation mandate. Yes, core prices are staying fairly robust, but they're still some way away from their 2% target. So I think the prospects of a US rate rise are slightly overstated.
Insightful analysis there coming from Michael Hewson, and of course he's saying that the credibility of central banks is being called into question. Thank you, Michael, Chief Market Analyst at CMC Markets.